After one of the worst trading days in history on Monday, Wall Street bounced back yesterday. The Dow Jones rebounded with a gain of more than 400 points, but getting there wasn't easy. The market slipped 200 points after the Federal Reserve announced it would keep interest rates at record low levels, but investors apparently warmed up to the news. Stocks rallied in the afternoon and the Dow closed above 11,000. Joining us from Washington this morning is Economist Peter Morici. Thanks for being with us.
Nice to be with you.
So the market's movements, is it a sign that the market is settling down, or do you think we're going to be seeing more volatility?
Well, markets will remain volatile, but I think the general trend will now be upward. We had 18 days of adjustment, and the market was terribly undervalued. There's a recognition that the Treasury is not going to have to pay more interest for bonds, and I expect the market to recover a lot of its value, and it'll take a couple of months.
So the Federal Reserve just announced that it will extend low interest for another 24 months. Has that ever happened before?
This is unprecedented that the Federal Reserve would announce its interest rate policy 2 years in advance.
And what is the import of that?
Well, the Federal Reserve has two objectives: to keep the economy going and to control for inflation. And right now it's saying we're not going to focus on inflation. We don't consider it a threat. The most important thing is to keep the economy from slipping into recession. And this is just the beginning. It has other tools in its arsenal, and it's prepared to take them out. It hasn't shot the pistol, but it's loading the gun.
Well, now, interest rates are already at record lows. What else can the Fed do? I mean, do you go to a negative interest, be below zero? How can you do that?
Well, the overnight interest rate is just about zero that banks borrow at, but the longer-term interest rate is still close to 3 on Treasury securities. It could buy those securities, bid up the price, and lower the interest rates that Americans pay on mortgages in the process.
Now, all of this volatility, at least the recent round of volatility, began when S&P decided to downgrade America's credit rating. And then we had this odd situation of people rushing to the very instruments that S&P said weren't credit worthy. What's your interpretation of what's going on with how investors are reacting to the downgrade?
Well, the best alternative to holding Treasury securities are euro-denominated bonds, European bonds. The thing is, there's no European authority that issues those bonds. You have to buy them, basically those issued by the member countries. Well, the largest issuer of euro-denominated bonds is Italy. U.S. Treasuries might not be what they used to be, but Americans and foreigners are not going to dump those bonds to buy Italian bonds.
So would you say that the investment community is basically discounting S&P's decision to downgrade America's credit rating?
Some institutions in the investment community must sell U.S. Treasuries because they're required to hold AAA paper. But by and large, it's a non-event. And I think all of this reaction in Washington, and we may even have Senate hearings, is really inappropriate. The U.S. government needs to cut back on how much it spends. It needs to reduce its deficit, and it should focus on its knitting, not criticizing the S&P.
You recently wrote that right now might be a good time for people to get into the market. Why is that?
After 18 days, the U.S. stock market was greatly oversold. The U.S. economy is going to grow in the second half, maybe not robustly, but will grow. And growth in Asia is going to be very strong. Well, American companies earn more than half of their profits abroad, which means they will have good profitability reports in the third and fourth quarter, and strong profits will drive stock prices higher.
But what about jobs?
Jobs will remain scarce. An economy that only grows at 1.5% or 2% per annum simply doesn't create enough jobs. We're going to need some fundamental changes in government policy in Washington that don't seem to be forthcoming to solve that problem.
Professor Peter Morici in Washington, thank you for being with us.
You're quite welcome.